Welcome to Should You Leave California to Retire? I'm Jim Cunningham, and we're going to talk about if the grass really is greener over there, wherever you're there might be. I'm a lawyer. I'm talking. This is not legal advice. So don't watch this and go do a bunch of stuff based on thinking that this is legal advice, because this is just information. Subscribe to our YouTube page. If you're watching this live, we are doing this live. We have a lot of attendees, a lot of interest in moving out of California. Go ahead and visit our YouTube page. I would really recommend that you subscribe to our YouTube page. Our content will appear in your feed, and so you can stay abreast of what is a very exciting year for tax attorneys. I'm Jim Cunningham. I've been an attorney 25 years. We've got offices in the Capital region, which is the Sacramento region, San Francisco Bay, and Southern California. I'm a certified specialist in estate planning, trust, and probate law, a real estate broker, securities, and insurance licensed. Here's what our firm does for our clients. As a taxpayer, you want to pay the least tax possible and not a penny more. That's most of our clients. We're here to help you craft a plan, give you options and make recommendations that may reduce your overall tax bill, leading to more wealth for yourself, your family, and your loved ones. So let's get to it. This kind of reminds me of the song from The Clash. I'm a Gen X guy, okay? Should I stay or should I go? That is kind of the fork in the road. And so for many of our clients, when we sit down and we do their estate planning, because one of the things we do in our firm is we sit down and we help people write up living trusts and powers of attorney and wills and other tax planning strategies. One big question that people have when they retire is, can I afford to retire in California? That's a big one. But secondly, should I go anyway, right? So let's look at some top destinations for people leaving California. Now, this is just on the numbers. This is pre-COVID, okay? So this is based on 2019 numbers. Texas is leading the way. Texas also happens to be a really big state, a populous state, so it's going to make sense. I would say Nevada has an outsized, when you look at the relative populations of Nevada, Arizona, Washington, and Oregon, Nevada really kind of has an outsized, it's an outsized destination. So many of our clients, they move to Reno, they move to Las Vegas, they might move to Incline Village. Incline Village is on the north shore of Lake Tahoe. So a lot of wealthier people move there, and not so wealthy, but it happens to be a very expensive place. And then I put asterisks on Washington and Oregon because there are a lot of hidden taxes in Washington and Oregon. So when we look at it, if our charge as the lawyers for our clients is looking at your overall tax strategy, Washington and Oregon do have a death tax, and we'll talk about that. So Texas, 82,000. I highlight Texas because some of you may have seen this picture, but this is me in 1977. Okay, little chubby kid with my parents. Notice my mom has a cigarette and my dad has a pipe. So that's from the 70s. In 2003, my parents moved from Ojai, which is in Southern California, to Northern California. And then my dad retired. He's a lawyer. He retired in 2018, and my parents moved to Texas. So they're one of those 50-odd thousand people that go a year to Texas. They love it. My aunt's there. My mom gets to see her sister every day, multiple times a day. Well, they love it, sort of. It's not California. They are missing some certain things, and we'll go over reasons to stay in California, right? So there are actually a lot of reasons to stay in California, and I'm going to hit the top 8. Number 1, if you plan on continuing to work in retirement, you really do need to look at the high wages that are made in California. So yes, California is expensive. We also have some of the highest wages in the nation. I'm an employer. Our firm employs about 40 people. Believe me, I'm living this every paycheck. Okay. I see that what the wages are in California, and then I'll talk to my colleagues in Texas or Nevada or Arizona. And in many instances, the wages are significantly less. There is that weather tax, right? Now, when I was preparing for this, my wife said, well, weather tax. Yeah. I mean, I guess, in some of those states that you're talking about, but gosh, Arizona's a nice place. So maybe there isn't a wealth tax in Arizona. Or weather tax in Arizona. There's an income tax, and they just raised it. Something else to realize is there's really kind of a donut that I see in our clients, meaning what that means is if you're wealthy, you can afford to stay. And frankly, if you're poor, you can afford to stay because your Social Security benefits aren't taxed. Now, really, if you earn less than $80,000 a year, state income tax really isn't that big of a factor. So this is what we're talking about is typically people have retirement income of greater than 80,000 a year. They start looking at that tax bill and they start thinking, well, that $5,000 I'm sending to the state, that could really make a meaningful difference in my retirement. Something also to understand is that pensions and IRA distributions are subject to income tax in California. but not in certain other states, and we'll talk about that. We also have a 900-mile coastline in California, and that's the one thing that talking to my dad, he says, I really miss the beach. I really miss the ocean, and that really does have a soothing effect, and it can lead to greater physical and mental well-being. So these are 13 states that do tax Social Security. So feel free to take a screenshot of that with your phone. So if you're looking to move to Colorado, when you kind of tabulate this, and a good place to start, quite frankly, is to go to your CPA or tax preparer and say, hey, this is what my taxes are in California based on my income. And we're just talking income tax. If I move to Colorado, what would my tax bill be? Or if I moved to Connecticut, what would my tax bill be? And so these are the states that tax Social Security. Okay, California does not. These 13 states do. Another reason to stay in California is culture. That's a double-edged sword, because some people, they leave California because they don't like what California has become. But California is a very multicultural. We have an abundance of culture. You can get authentic French pastries for breakfast and traditional Japanese sashimi for dinner in the same city. That isn't the case in many of these other states. And frankly, California is the most diverse political entity in the history of mankind. More than 120 languages are translated in the California courts. 120 languages. It's a lot of languages. So some people, they say, I'm tired of that. Some people say, I love it. It's exciting. So that's just a thing to think about, more of a lifestyle issue. And the the vineyards and wineries, Napa, Sonoma, Santa Barbara, that's a great cultural thing to do. It's natural beauty, whether you drink or not. These are very beautiful places to visit. So food, this is actually really, personally, something I put a high value on, is good food. And I live in Sacramento. Sacramento is a great place. If you love food, Sacramento is a great place to buy food, even at a store. It's very fresh, farmers markets. You'll go to a farmer's market and say, where are these pears grown? They say, well, they're grown 5 miles down, we're in downtown Sacramento. They're grown 5 miles that way. So it's kind of cool. So California, obviously this cornucopia of great food, recreational opportunities. Our main office is in Auburn, California. Auburn, California happens to be right next to a national recreation area because they were going to dam the river. And so the federal government bought up a bunch of land, but literally from the city of Auburn, you can go into a trail in what's basically wilderness. So it's just fantastic beauty. A lot of outdoor recreational activities. And frankly, we have weather where, you're typically not going to have the ice and all that stuff. So I just wanted to highlight reasons to stay. So some people leave California. And really, I think if you're watching this, you're probably thinking, should I leave California too? Right? Is that an option? Is that something I should be looking at? Well, I think people leave California for a variety of reasons, but as I did research, the bottom 4, quite frankly, desire for change, closer to family, returning to your roots. Some people say, I grew up in this, in Tennessee. I'm going to go back to Tennessee because that's where my roots are. And politics, people frankly are moving because of politics. So California is a very left-leaning state. Many clients say, I don't like the political climate. I'm going to a state, I'm leaving this blue state. I'm moving to a red state. I'm not going to talk about those 4 things. I'm going to focus on things that are kind of quantifiable with math and really the purview of CPAs and lawyers. So why do people leave California? What is the attraction? It's a push and a pull. What pulls people out of California into another state? Number 1, timing of retirement. So it's not just, can I afford to retire, but when? Outside of California, it can be more affordable, not always, but it can be more affordable. And quite frankly, just less tax. Some people say, I can afford to pay the tax. It just bugs me so much. I don't want to pay that extra state income tax. And remember, California state income tax is a maximum 13.3%. So what do I mean when I say retire sooner? What do I mean by that? Well, the typical advice that I hear and out in the ether is you need to replace 70 to 90% of your annual pre-retirement income through savings and Social Security. So if we had an example here of Hal earns an average of $100,000 a year, and Hal wants to retire. And so based on this range, Hal will need $70,000 to $90,000 a year in retirement. And he gets $30,000 from Social Security. So figuring a 4% rate of return or a 4% rate of withdrawal, Hal needs $1 million at $70,000 a year and $1.5 million for a $90,000 a year income. So what I mean is I took 70,000, I subtracted the Social Security payment, that left 40. If you take 90 and subtract 30, that leaves 60,000 a year. Well, that income has to come from somewhere. And for many people, it comes from savings. So what I did here is I quantified it. How much does Hal need to have? And this is an example. I'm not saying, everyone can live on this and everyone gets 30,000. I'm just giving an example of the numbers to illustrate a point. With $1 million, Hal, who's 65, can retire where the cost of living is $20,000 less per year than if it were 90,000. So if Hal's 65 and he says, I've got $1 million, I can retire, but I need to move someplace where it's going to cost me 70,000 a year and not 90. Hal can retire at 65. If Hal says, oh, I need 90 because I'm in a higher cost area, a more expensive area, he's going to have to delay his retirement 2, 3, 4 years, whatever the time is to save that extra $500,000. So the key takeaway of this is I think it's really important when you budget your retirement, look at your overall expenses. And when it comes to moving out of the state, because you may not need to move for economic reasons, okay? You may be able to stay here just fine. And one other kind of consideration is people say, you know what, California's gotten too expensive. It is cheaper in another state, okay? So one of the things we have to look at, a huge benefit for those of you who've owned property for a long time or even a short time, a huge benefit is Prop 13. And we're going to talk about this for a little bit. And this is something to factor in because many people, when they move to another state, their property taxes actually go up quite a bit. So it's something to pay attention to and learn about. But we're going to answer a couple of questions. Donald asks, can you comment on news articles stating that California intends to find ways to tax former residents who spend 7 months in another state and only 5 months in California? I'm not aware of that particular one. I'm aware of one that says if you live here and then leave, you have to continue paying California income tax for 10 years. That's what New Jersey has. So Jeannie asks, so when leaving California, is there a time of year that's best? When you are leaving California and you no longer want to be a California resident, you need to spend less than 6 months in the state. By definition, that means leaving no later than June 30th, okay? And not coming back in that 1 year. So to answer your question, there is a best time of year, but it's the first half of the year. Will you cover what is the minimum requirement to claim Nevada residency? Yes, we will. If you have to leave, oh, hey, Karen, how you doing? If you have to leave California, buy a small property first. That way you can possibly come back. You know, Karen, that is so wise because a lot of people, they move out of state and it's great for a couple of years and they go, I don't like it. I want to go back. So many people, when they leave California and you sell your property, many times you can't afford to come back. And Prop 13 is a big reason. Is it better just to rent in retirement? You know what, Michelle? My mother-in-law, before she passed away, did live in essentially a low-income senior housing environment. And I think at the time it was $850 a month. That might be a consideration. Now, many people say, I don't want to rent in retirement because I can get evicted and they can change the use of the property and I don't own it. It's not mine. The fact of the matter is if you're in like a 55 and over senior apartment complex, they're not going to kick you out. They're just going to let you live there for as long as you can because the zoning is 55 and over and that's the structure. So I think renting is a consideration in retirement. I think certainly if you have a high dollar home in California, if you rent that home out, your rate of return is not the rate of return that you would get in certainly investing in real estate in other locations or having a professionally managed portfolio of stocks and bonds. Hey, Jeannie, your husband is online. Great. We live in California. Our gross income is approximately $90,000 and my wife's Social Security income is partially taxed. Okay, Ralph, check with your CPA. So if you benefit from low Prop 13 taxes starting April 1st, you're going to have a great opportunity, okay? And this is the ability to take your Prop 13 taxes with you. So I'm going to go over concept. There's a home in Cupertino. This is actually on the MLS for $2 million. The property was purchased for $50,000 in the 70s, and the property taxes only go up 2% a year, and I'll explain that. So the assessed value of the property. So when you look at your tax bill, the assessed value, that's the number that the county uses as the basis to charge 1%. That property is assessed at $120,000, even though the value is $2 million. So the taxes are about $1,500 a year. The next door neighbor who just bought last year, they're paying $20,000 a year. So there's really tax inequality, right? In the sense that if you've owned your property for a long time, your taxes are a lot less than a comparable property next door. That is not the case in most states, okay? So Prop 13, when a property sells, when a property trades, when it's bought or sold, or somebody dies, a lot of people don't realize that death is a change in ownership. When somebody dies, there's a change in ownership. And what that means is that property we talked about, that $2 million property, that gets reassessed, and the taxes go from $1,200 a year, $1,500 a year to $20,000 a year. Say they go up because somebody died or it was sold. The taxes, so the taxes are capped at 1% of the value of the property. Texas, I see some property tax bills at 3%. Okay, we'll talk about that. So this 2% annual cap really keeps the property taxes, especially if you have a legacy Prop 13 property. It really does keep your property taxes low and, more importantly, stable. So one of the nice things about California's property tax system, it is a very stable system. You can agree with it, you can disagree with it, but you can just financially project what your taxes are going to be in 20 years. So you have a little bit more certainty when planning for your retirement. So that would be, that would be an advantage of keeping your low Prop 13 taxes. So let's say you move to Texas. Okay, Texas levies a 1.6 to 3% tax on a property's assessed value. Property can be reassessed. They're not capped in the same way that California is. So if a local county says, hey, we're kind of short, we had that big tornado and I don't know, whatever, we want to raise taxes, it's a lot easier to raise taxes in those jurisdictions outside of California than it is in California. So again, less certainty on the, but properties are cheaper in Texas on a per square foot basis or a unit basis. They're just across the board less than most areas in California. Although that being said, there are some areas, Dallas, Fort Worth, Austin, that are just as expensive as California. So don't think that by, hey, I can move to Dallas in this old established neighborhood. You might be paying $1 million for a, kind of a small house. So there are real benefits to staying in California. So let's say you retire and you're like, you know what, I'm tired of living in Cupertino. I'm going to move up to the Sierra foothills, and I want to buy this house. And this house actually costs less, believe it or not. This house costs less than that one. Okay. And this is a nice big house on the western slope of the Sierra between San Francisco and Tahoe. So how does this work? So before passage of Prop 19 becomes effective today, right? This portion of Prop 19. Before Prop 19, Prop 60 and 90 let you sell your residence and replace it with another residence, either within the county or in one of 10 other counties, right? And the requirements are you have to be 55 or older. You can only do it once. The home you're selling must be reassessed. This is really important. You can't transfer it to your kids and get some, now there's a limited parent to child reassessment exclusion for a residence, but the property has to be reassessed. You have a 2-year time limit, and it has to be the same market value or less. It can't be more. Now, that being said, if you wait a year or two, it steps up a little bit, and you have to file a claim to have your property taxes reduced. So prior to Prop 19, you sell your Cupertino house for $2 million, you move up to El Dorado Hills for $1.75 million, your property taxes jump to $20,000 a year. They're actually a little higher because they have something called Mello-Roos, which are extra taxes on top of your Prop 13 taxes in this community. But my point is your taxes go way up, okay? And that may be, I really don't want to live in Cupertino. I want to live up in El Dorado Hills, but gosh, that $18,500 a year extra in tax, yeah, I'm gonna have to have some more savings. I'm gonna have to work a little bit longer to pay that tax. Okay, so this starts to get into the timing of when you retire, and then can I afford it? So there are two things. El Dorado County is not one of the 10 counties, right? So Prop 60, Prop 90 is not gonna help you, even though the property is of less value because it had to be one of the 10 counties. So after Prop 19, you sell your Cupertino house for $2 million, you buy your El Dorado Hills house for $1.75 million, your property taxes stay at $1,500 a year. All right, or $1,200, whatever they were, because of Prop 19. Okay, the point is they stay low because you're able to transfer your tax base anywhere in California now, not just the county in which you're residing in intra-county transactions. So those were always, you could always do that. But now with Prop 19, you can go anywhere in the state of California. So I think this really is a big deal. Many people have a home that might be worth $2 million and they say, I don't want to buy a $1.75 million house. I want to buy $1 million house or an $800,000 house. Well, setting aside capital gains tax issues for the moment, that $1 million or $1.2 million can be invested and provide you a return to accelerate the date of your retirement. So if you're thinking, can I retire? When am I going to retire? How much money do I have? You can see how these all kind of come together with the lawyer, the realtor, the CPA, the financial advisor. You need to assemble your team to really crunch the numbers and look at it. But something to bear in mind is there is a real advantage of staying in California if you have Prop 13, especially because of Prop 19. So now, another example, let's say you sell Cupertino and you buy Piedmont. Now, Piedmont is a beautiful community surrounded by the city of Oakland in the East Bay, just across from San Francisco. Your property taxes are going to jump, even with Prop 60, Prop 90, okay? Property taxes are going to go to $27,000. Alameda County is one of the 10 counties under Prop 60 and Prop 90, but because the market value is greater, you get fully reassessed. But with Prop 19, the property taxes only go up by the difference in market value from the house that you sell and the house that you buy. So stated another way, you sell Cupertino for $2 million, you buy Piedmont for $2.3 million. $2 million of Piedmont keeps its low tax base, its low Prop 13 tax base, and the extra 300, well, that gets reassessed at 1%. Okay, so Prop 19, huge benefit for people over 55, huge benefit if if you have a long-term property that you've been holding for many, many years and has low Prop 13 taxes. So please don't discount this when you're looking at, should you stay or move to another state, because to get a replacement residence in a desirable place to live, you need to look at the property taxes, because that's something that you're going to have to pay and something to be very, very mindful of. So a recap, again, you're saving $20,000 a year, you're saving, $22,000 a year with Eldorado Hills and Alameda. I like to quantify this over a 20-year period. If a retirement lasts, 20 years, let's say you have the house for 20 years, you're saving $450,000 because of Prop 19. You're saving $528,000 in the Piedmont property. So what I'm suggesting is that when you add up the total expenses to live, don't ignore property taxes. They are higher in other jurisdictions. If you have Prop 13 taxes, that's a plus. And that may be something that allows you to stay in California and move to a lesser house and use that difference to live on or whatever it may be. So we have another question in the Q&A. Michelle asks, if you are planning to work for the rest of your life, and I am 60, California is best. Michelle, you're going to work for the rest of your life. Yeah, that's a consideration, high wages. It definitely is. Now in this post-COVID work, if you're still working, I'm assuming it's not physical labor. I'm assuming it's some type of brain work, some type of professional service. You can do that remotely now, right? You don't have to necessarily live in California. There are licensing issues that go with that, but in this post-COVID world, you might still be able to get those higher wages. Can you comment on apps such as Moneo and TaxDay that seamlessly prove you live in low tax state? These could be useful for audit purposes. Yeah, there's a lot of software out there, and I would really encourage you. If you want to do this on your own, there are a lot of calculators out there online. If you want to do it with a professional, probably the best place to start, frankly, is with your tax professional, whether it's your CPA, enrolled agent, or whatever it is, starting with that person and say, look, all things being equal, if I live in California for this tax year, if I lived in another state, is there a meaningful difference, right? This is taxation of income, not so much expenses, but taxation of income. You're certainly qualified to calculate your own expenses, but the income, it requires a technical analysis. So many California residents before Prop 19, frankly, couldn't afford to sell their house and move to a more affordable part of California, primarily in many instances because of property taxes. Okay, so if you're in LA and you've got, the Piedmont or the Cupertino example, a $2 million house, if you have a $2 million house and Social Security income, you can't sell that Cupertino place and buy something in El Dorado County, which is not on the 10 list. It used to be, but it's not, because now your taxes are $12,000 a year. It's just not going to make sense. So I see this as a huge benefit for people who are really kind of living on a fixed income and can move. Not applicable to out-of-state transfers. So people do ask, hey, can I take my Prop 13 with me to Tennessee or Texas? No, that's Tennessee and Texas is not California. Does the property have to be your primary residence? Yes, on this, it has to have the homeowner's exemption checked. Now, this is really important because Prop 19 has some pretty interesting requirements and some pretty arcane requirements. You have to be over 55. Now, I don't know what that means. Does that mean you have to be 56? Or does that have to mean 55 in a day? We don't know. We're waiting for clarification from the legislature. If you are severely disabled, it's actually defined. If you're the victim of a wildfire or the victim of a natural disaster, you can move your tax base. So pay attention to that. And we don't know what the time. I mean, if you're a victim of a natural disaster 5 years ago, can you still move your tax base? I don't know, right? We don't know yet. You're limited to 3 times. If you're married, can it be 6? We don't know yet. If the property is of a greater market value, remember the Piedmont example where it was $300,000 more than the $2 million sales price, the difference is added to the tax base. It is not the whole property being reassessed, this is the really big difference between Prop 19 and Prop 60 and 90. Prop 60 and 90, if the property was, in that example of Piedmont, the entire property would get reassessed and your taxes would go from $1,500 to $27,000. It's very important, the homeowner's exemption. How do you know if you've checked the homeowner's exemption? Look at your tax bill. Every tax bill I've seen in California, if the homeowner's exemption is checked, it subtracts $7,000 from your home. If you're a disabled veteran, I want to say it's about $136,000. It's a better exemption. So it's just very important to pay attention to that. And then there's a time period. Another important issue is you have to claim your homeowner's exemption by February 15th for it to be effective. Otherwise, it's prorated for the year. Okay, so the other benefit of a homeowner's exemption, kind of dumb. I mean, it's not dumb. They take $70 off your taxes. I mean, like, big deal, right? But $70 is $70. So we have some questions here. How long do you have to live in an inherited house for it to be considered your primary residence? Will you then be able to sell the house and have Prop 13 protect you if you move? What's the capital gain we'll be paying? TJ, interesting question. Prop 19 says, you're talking about if someone inherits a house. So let's say you do this transfer and you move from Cupertino to El Dorado Hills, and then mom and dad die and they leave the property to the child. As long as the parents have checked the homeowner's exemption and the child has 1 year to make that the child's home, meaning check the homeowner's exemption on the property taxes, but you have to do that within a year, then you preserve $1 million of reassessment exclusion. But anything above the assessed value plus $1 million in market value, if the property's worth more than that, that portion does get reassessed. And hi, Tammy. Oh my gosh, Tammy. Hi, Tammy. Tammy Finkbeiner. I haven't heard her name in a long time. So thank you, Linda, for saying Tammy says hi. Jeannie asks, if we keep vacation property in California, then sell our main California property to move out of the state, will the California vacation property remain vacation property? Is there a status change for the vacation property? No, Jeannie. So if you have a vacation property and you own it, that's your Prop 13 tax right. Okay, your taxes only go up 2% a year. When there's a change in ownership, property's reassessed. So when you die, if it goes to somebody other than your spouse or registered domestic partner in California, it would be deemed essentially a reassessable event. So subscribe to our YouTube page. This is really great to stay abreast of all this important stuff. Now let's talk about probably why a lot of you are here. I wanted to talk about the concept of retiring sooner rather than later. And I wanted to talk about the good stuff in California, as well as don't forget about Prop 13 taxes, because I think people don't, I'm concerned they're not paying enough attention to it. And it's a very important, a very valuable property right. Lower state income tax. So this is where a lot of people say, I'm moving out of California because I don't want to pay California state income tax. Now, again, if you're under $80,000, it's not that big of a deal. I'm not saying, get over it, but it's just not that big of a deal. It's once you hit 80, then it really starts the numbers get big. TJ asks, if we sell our home way below market value, will they pay less in property tax? TJ, you can't game the system. The assessor's job is to assess property, and they assess it at market value. So if I sell you Blackacre for $1 and Blackacre's worth $100,000, they're going to assess it not based on the dollar, but the 100,000. So lower state income tax. Don't forget the hidden taxes. There are a lot of hidden taxes that other states have that California does not. Now, do not fall out of your chair. Pick yourself up off the floor California does not tax everything that other states do. So a foundational concept is source tax law. This is an American concept. It's actually a federal law that prohibits a state, including California, from taxing pension income of non-residents, even if the money was earned within the state of California. 85% of public employees retire outside of California, 85%, okay? So the money that the state is paying them in their pension, that is not subject to California income tax under federal law. So if you earn your pension with CalPERS and you move out, you're not going to be paying California state income tax. However, California source income tax rents, for example, bank accounts in state chartered banks. Okay, if your bank is a state chartered bank and you get interest, as small as that interest may be, at least at the moment, that is going to be subject to California income tax. Tennessee, we're going to talk about Tennessee, Walter. Tennessee has no state income tax. It's pretty cold and they get tornadoes. My ancestors are from Tennessee, kind of North Carolina, Tennessee, and Missouri, many moons ago, pre-Civil War. Rents from California are subject to California state income tax. What about if you do a 1031 out of California? So a lot of people, they say, man, I'm gonna game this system. I'm gonna take my California real estate and I'm gonna do a 1031 exchange. And what a 1031 exchange is, you can exchange like for like, meaning if you have a rental property in California, you can exchange that for a rental property in Texas or Florida or Tennessee or Alaska. You can do a tax deferred exchange, meaning you sell one property, you buy another, and you defer, you don't eliminate, you defer or pay later, potentially, capital gains tax. Well, in California, they make you fill out a form. And what this is if you're leaving, if you buy an apartment building for $200,000 and you depreciate that apartment building to 50, meaning your cost basis is 50, and now it's worth $1 million, that's a $950,000 taxable gain. When you do a 1031 outside of the state of California, you have to file this form. This form basically says, if and when you ever sell the property in the future and you're not a California resident, you have to pay California taxes, at least on that gain, and you're reporting that to the state. Now, whether or not that's lawful, I suppose it's California source income. Whether or not the state is going to still pursue this, I don't know. What if you never pay them? That's tax fraud. You're not following the rules with California. And if a client says, hey, I want to sell this property and I want you to advise me that I don't have to pay the tax to California, right, on the property I 1031 out of California to Texas, I'm going to say that's not what the rule is. You got to pay it, right? Once out of state, if we use a credit union, will California tax interest earned on accounts? Well, you would use a credit union not chartered in the state of California. So banks many banks have state charters, and it's important if you put it in a brokerage account. Okay, for example, that's not a state chartered account, or the brokerage account's a little bit better. Okay, or an out-of-state bank. So Hal retires in California. He's a public employee, and again, like 85% of California public employees, moves somewhere: Tennessee, Texas, Alaska, Nevada. They can't tax his PERS pension, even though that check is getting written by California, because he's not a California resident. But again, once the property that Hal 1031 to Texas is sold, under law, he's got to pay California their portion of tax. California, non-residents do not pay California income tax on IRA distributions, capital gains on stocks, interest on non-California bank accounts. So if Hal has a $3 million IRA and maybe his minimum distribution is $120,000, that's a lot of money. And that's just added on to his other retirement income, okay? By ceasing to become a California resident and becoming a Texas resident, Hal avoids California income tax on IRA distributions, even though those IRAs were earned in the state of California. So again, I think you can see if somebody says, well, Jim, I don't really have an IRA. I'm not going to have these big minimum distributions. And frankly, I have a lot of rental income from California real estate and a lot of depreciation. And I think I can just stay in California. That's a lot of our clients. They stay in California. If you have a lot of real estate and you say, I'm tired of paying California tax, I'm going to move to Texas. Remember, California source income, you're going to have to pay the California state income tax, really. Yeah, you're going to have to do it. Not any way to get around that. If it's California source income, you're going to have to pay it. Now, what is a non-resident? So somebody asked, hey, what's the process of stopping to become a California resident? Okay, so what do you do? What are some some things that you can do. Well, you have to stay out of California 180 days or more, right? You can stay in California less than 180 days. It's another way of saying it. So 180 is half of a year. What I see the successful cases, you register to vote in the state that, for example, you moved to Nevada, you register to vote in Nevada, you have your driver's license in Nevada, you register your cars in Nevada. But I will tell you, the Franchise Tax Board checks everything. They even dumpster dive. So they were kicked out of Las Vegas, kind of a famous case. They'll track your cell phone. They were in at somebody's dumpster in Las Vegas, and the sheriff's department kicked out the California franchise, whoever the investigators were. They said, no, you can't come to Nevada and do this. So they're looking with a fine tooth comb. And I will tell you, California is very aggressive when it comes to collecting the state income tax. Now, states with no sales tax. Sales tax, not so much of a big deal with clients in retirement. They're typically not big consumers of stuff. So Michael asks, I plan to move to Nevada, then convert a large IRA to Roth, and later move to Oregon. Will this work? California can't claim I didn't intend to leave, and Oregon can't tax a Roth conversion before I arrive. How long should I live in Nevada? Michael, that's a really good question. I think that's, kind of the in between attorneys and CPAs. In terms of if you're a California resident and you take a withdrawal from your IRA, you're going to be subject to California state income tax. If you're a Nevada resident and you're not a California resident and you take a distribution from an IRA that should not be subject to California tax, Oregon has actually a higher income tax than California does. Okay, so a lot of my clients move to Oregon, and they have pretty much a flat tax. And so even if you're a lower income earner, you pay state income tax. There's no sales tax, but they do, as I mentioned here, they do have a high income tax. So let me see, we have another question here. Yeah, if you guys have questions, just put them in here. I hope this is helpful. Jeannie asks, what does that FTB tracks your cell phone? They subpoena the records. They say, we're taking you to tax court. You have a $200,000 deficiency. And then they subpoena your phone records. It has nothing to do with area code. It's work because your phone tracks where you're at. If I move out of state, but have deed of trust accounts on California property, is that California taxable? Probably, right? So if you have lent money and it's a note that they're paying on, I would think California would take the position that the note is secured by real property, and therefore it's enough of a nexus to charge you income taxes on that. I don't know for certain, but I've never heard of a client who moves out who's like, I'm not paying any more income tax on the income I'm deriving from my California notes. So I think that stays California. States with no income tax at all. Now I highlight these because New Hampshire, if you look here, they don't have sales tax, Alaska and New Hampshire, and they don't have income tax. So if you're going to have a big income and you want to buy a lot of stuff, they're cold places, I guess, beautiful places. Even New Hampshire has a coastline. But these are states with no income tax. And this is very important, again, because California's maximum tax rate, at least currently, is 13.3%. And some people are advocating it to be 16.3%. So no sales tax. And see, Washington here has no income tax. What some people do is they live in Vancouver, Washington, which is across the river from Oregon. And they live in Washington and don't pay state income tax. And then they go to Oregon to do their shopping, and then they drive back to Washington. So they kind of game the system a little bit. Some oddball rules, some weird ones. I think these are worth mentioning. Illinois, Mississippi, and Pennsylvania don't tax distributions from 401k plans, IRAs, or pensions, but they do have a state income tax. So there's a carve out for retirements and pensions. Alabama and Hawaii don't tax pensions at all, but do tax distributions from 401ks and other income. And of course, the federal government, as you know, they tax everything, right? Now, one thing people don't pay any attention to in California is a state death tax, because we don't have one. Okay, a little spoiler alert. We don't have a death tax. Don't tell anyone in the legislature. Don't tell anyone in government. It was eliminated by the initiative process in 1981. So we used to have a death tax. Now we don't. Many states have a death tax, and this is a death tax on two different levels. So what is a death tax? The federal death tax kicks in on amounts over $11,700,000. That's a crazy high number. When I started practicing, it was $600,000. $600,000. Okay, this is a crazy high amount for the vast majority of people. And the rate is 40% on amounts over 11.7 million. So if you have a $21,700,000 estate, 10 million is subject to tax. $4 million is due in taxes, regardless of whether it's real estate, a closely held business, farmland, a stock portfolio, money in the bank, whatever it is. The government says that you have to add everything up and send in a check within 9 months, which is not that much time. So the most egregious offender when it comes to Maryland gets the #1 award for most egregious state death tax offender. Maryland has both an estate tax and an inheritance tax, and it's 16% on amounts over 5 million plus 10% for distant relatives. So 26%. There's a federal of 40. Those start to get really big numbers. So Maryland, if you're concerned about paying death tax, this is tax that's paid when you die. I have news for you. We've helped a lot of people, and many of our clients, they pass away. It's just the nature of estate planning. No one has yet taken their stuff with them. In fact, it doesn't go with you, it stays here. So wherever you go or don't go, whatever your religious belief is or isn't, your stuff's going to stay here and it's going to be taxed. Okay. Washington has a top estate tax rate of 20%. That's a lot. Hawaii, 20%. And that's over 2.2 million in Washington. So you might think, wow, 2.2 million. I mean, 2.2 million is a lot of money. But on the other hand, a lot of people who are retired have 2 million in assets. So Washington's going to subject that estate to up to a 20% death tax. Vermont has one as well. And Minnesota has a maximum estate tax of 16%, but the minimum of 13 is higher than every other state's minimum, with a $3 million exemption. So that is the gift death tax. Estate tax is something so what's the difference between a death tax and an estate tax? A death tax is kind of a political term. An estate tax is a very technical term. It says the estate tax is essentially 1/2 of the death tax. A death tax is a broader descriptor. The estate tax is the estate that a decedent's estate pays. So if it's a decedent's estate in Oregon of $2 million, you're going to pay 10 to 16% on amounts over $1 million. In dying a resident of Oregon with a $2 million estate. Now, you're not paying federal because it's 11.7 million, but you have to be mindful and pay the state. Now, many of our clients in Southern California and Northern California have property in Oregon. And here's how Oregon treats their death tax, their estate tax. If you own a $100,000 property in Oregon and you have $1 million California estate, when they look at the value of your estate, they include your California assets and they put the Oregon property on top. So you can think of a layer, like a cake, right? With a layer on top. And Oregon looks at that very top layer and they add in your California assets to get you up to that level so that there's an estate tax to pay. Massachusetts also has an estate tax. Rhode Island, Illinois, New York, DC, Connecticut, Maine. Generally speaking, Oregon, Washington have death taxes, and the further east and the further north you go, the higher the probability is for a death tax, some type of death or estate tax. An inheritance tax is a tax on the recipient. So an inheritance tax means the estate tax is the estate of the deceased person pays it. The inheritance tax means the person who is inheriting the money has to pay it. It's almost like an income tax. You can think of it as an income tax. And we have 4 states that impose an inheritance tax. So this is very important when we're counseling clients. If you have loved ones in these states, Iowa, Kentucky, Nebraska, a lot of clients with kids in New Jersey, a lot of clients with kids in Pennsylvania. And we need to consider the state inheritance tax because there's a way you can structure an inheritance so that it is not counted as an inheritance for an inheritance tax purposes. So how much is California's death tax? Spoiler alert, there is no estate tax, inheritance tax, or death tax. Shh, don't tell anyone at the Franchise Tax Board, they might bring it back. So to recap, why do people leave California? To retire sooner, can be more affordable. That's that economic analysis, and then state income tax, which of course ties into affordability. If you want to talk about estate planning, if you want to talk about, hey, Jim, I've got these assets in California and I want to move out of state. What's the best structure? Who are the advisors I talk to? I got to get my A team together. You can go ahead and go to our website and book a time to meet, or call the number that you see there on your screen. Subscribe to our YouTube page. I will open it up here for questions, and I will go back. Really, subscribing to our YouTube page, I think, is one of the most important things that you can do, because it pops up in your YouTube feed, literally on your TV. So it's kind of cool. And we have, we're always having the new content, fresh content, and we do have guest speakers as well. Dina said, what did you say about Arizona state tax increasing? Yeah, Arizona state income tax increased. So they passed a tax increase on the last election. I think the maximum rate is either 9 or 6. I don't know. I saw that they had increased their state income tax. And let's see here. My brother and I inherited a duplex from our parents. I'm renting one of the units while my brother is living in the other unit as the primary residence. I'm receiving depreciation on the property. How does this affect the value of the property? Does it affect each portion differently? What happens to the value when the house is left to our children? I think, TJ, that's a good question for your financial advisor or your CPA, tax preparer. Probably your half interest gets depreciated. He's living in his half interest, and that's probably how it would be treated. So you're essentially getting half. And Lola says, a very timely and helpful topic for our family. Thank you so much for another excellent webinar. Well, thank you. Carl. Hey, Carl, how you doing? Do you see Prop 13 being diluted in the coming years? Yeah, well, I mean, it's been eroded by Prop 19, right? But Prop 13, when it comes to your primary residence, I think that is basically the third rail in California politics. No one's going to touch it. I think that the Prop 13 protection for your home while you're alive and you own it, I don't see that going anywhere. There was a proposal to do what's called split roll on the last election, which would tax commercial and industrial property different, basically at fair market value, but not residential. That narrowly was defeated. 49% yes, 51 no. I can see, and I'm not calling it, but I can see a new ballot initiative that brings back the parent-to-child reassessment exclusion, or basically takes the bad stuff out of Prop 19 and pays for it with a split roll on commercial and industrial property. And there's a logic to that. I'm not saying I agree with it or disagree with it, but there's a logic in terms of keeping housing prices lower, or housing taxes lower and protected by Prop 13. You mentioned to construct your A team. Can you recommend a CPA? Yeah, Ron, there are a lot of different CPAs out there. One that has done many events with me is Chris Mann, the Munn firm in Roseville, MUN, and they've got offices in Roseville and Sacramento and Glendale. So that's good for our Southern California clients. And I would recommend that you reach out to them. We've also done some tax webinars. So if you go onto our YouTube page, you can see some of the content I've done with Chris. Where can I learn information about federal and state taxes assessed on income if I move out of country to be a sun-baked expat? Great, great question. Probably web research. I don't know. It depends on can you live where you're going? We're not, necessarily the experts where people come to us and they say, hey, given these factors, what are the best countries for me to move to? I think that's probably a great business, but that's not really something we do. We counsel our clients where they say, hey, I'm moving to Georgia, or I'm moving to Texas, and I made that decision. Just help me with the structure and what this all looks like. By the way, if you are a California resident, you've done a California state plan, you move to another state, you absolutely have to have your state plan looked at. Changing your state of residence can have outsized tax consequences, can have outsized consequences when it comes to who inherits from you, who succeeds to your property. Well, I think if we have no more questions, it looks like that's a wrap. Thank you for joining us here, and please subscribe to our YouTube page and stay abreast of all the content that is coming your way. Have a great day.